if there's an upside to $5, $6, $7 gasoline, maybe it's the fact that for the first time in 40 years, we get to have a real argument about inflation again. 40 years ago, George's book, Wealth and Poverty, helped us get out of the stagflationary 1970s. And obviously in the last 2 years or so, we've seen the first revival of large inflationary numbers since that time period. So we're going to have John Tamny come out here and join us. John is the editor of Real Clear Markets, which is one of the first things I look at every morning. He does a great job in finding all the best commentary and news and finance and technology and economics and policy every day. He's also a vice president at FreedomWorks. He's a prolific columnist and thinks an awful lot about money, inflation, the future of money. And so we're going to have John give us a little overview of where he thinks we are right now, where we're going, and then we'll have a discussion with George and the rest of you.
And he has a new book.
And a new book. Tell us about the book, too.
The Money Confusion.
Yeah, The Money Confusion, which it's on Amazon, and all of you should buy several copies of right now. I expect to see you on your phones right now purchasing that. Thank you so much to Bret. What a treat to be introduced by him. Bret wrote a column in the Wall Street Journal about 17 years ago called The Elephant in the Barrel, because he was one of the few red-blooded human beings on earth who understood that oil never got expensive in the 2000s. The dollar was in decline. This is easily forgotten today. Oil sextupled at one point during the 2000s. No one's talking about that. They just claim that a 38% rise in modern times signals a war on fossil fuels. Memories are strangely short, but thank you so much. What a treat to have you and to be up here talking to George, one of my heroes. If Ronald Reagan quoted George more than anyone, I think I've quoted George more than any living writer. And so what a treat to do this. Now, again, I'm going to briefly, before we talk about my book, again, The Money Confusion. All of you should buy several copies. This is a book that rejects, it's a mercifully very short book that rejects just about all the conventional wisdom about money and inflation that's been spreading around for decades and realistically for the past 100 years. None of it stands up to most basic understandings of how the world works. And to give you a flavor for it, it's worthwhile to travel back in time to early 1920s Germany. Easily that's the biggest and most famous devaluation in the history of mankind. And during that, as many of you know, the mark fell to 1/4 billionth of a dollar. What's unfortunate about it is it's so misunderstood. To this day, there's this imagery of someone bringing a wheelbarrow to market full of marks. And so it creates this perception that marks were circulating just in enormous amounts, and that was, quote, inflation. In reality, the surge in the supply of marks was what happened after the inflation. And that's always the case. The mark was devalued, at which point it disappeared from commerce. And that it disappeared from commerce was a statement of the obvious. And what it's a reminder of is the basic truth that no one buys or sells with money, nor does anyone lend or borrow with money. Underlying all money flows is the flow of goods and services. When I buy something from you, I'm trading products for products. You take the money because you trust it, because you know that you can get other products for it. When you lend money, it's because you have access to resources to someone who wants access to resources. And so this is important in consideration of what happened in Germany. Of course, marks weren't circulating because the mark was no longer trusted. And it's important because there's this view that is passed around to this day that somehow money supply is the driver of inflation. No, inflation is a departure from a monetary standard. Excess money is what happens after you depart the monetary standard, and it's no longer circulated simply because it's not trusted by producers. And this is important in consideration of what we hear a lot from libertarians today. I'm going to call out my good friend Marion Tupy because he works at the Cato Institute. And at Cato, all of its money philosophers there think that because there's no market for money, that they need to plan it. That the central bank, with them in charge, would basically plan the supply of money on the way to planning GDP and income and demand and all these things. Central planners in the former Soviet Union would blush. The simple truth is that in any economy, money in circulation, by definition, reflects goods and services in circulation. It's an exact concept. Money has no purpose where there's not production. And the notion that there's no market for money is belied by what we see in the world today. If any of you were to land in Tehran or Caracas or Pyongyang, 3 enemies of the United States, and you actually wanted to get goods and services while there, you had better have dollars in your pocket, because that is the currency of commerce in all 3 countries. Did the Fed put those dollars there? Did it increase so-called money supply as the fabulous around the world and the economics profession claim? No. Money always and everywhere exists where there are goods and services to move around. It's an exact reflection. It's a market phenomenon. And this is important in consideration of Bitcoin. The view about Bitcoin, people who say it's the future of money say that its merit is that it's limited in supply. Again, this odd view, this odd focus on money supply as the way of limiting inflation. It gets it exactly backwards. We don't worry about the number of foot rulers or stopwatches. We just worry that they're accurate. And money's no different. When money is stable, its supply is immaterial, or because it circulates everywhere. And so people say, well, there's only 21 million Bitcoin, so that's what makes it money. In fact, that's the surest sign that it will never be money. And it won't be because the focus there is on supply rather than its stability as a measure. And because there's no focus on stability of measure, who would ever use it as money? Again, if you look throughout history, money wasn't brought to us by governments. Money is as natural a consequence, once again, of production. Wherever there's production, there will always be money. Wherever there are goods and services to be moved, fear not, the most stable measure will emerge as money. In Germany, after World War II, it was cigarettes. The currency was no longer trusted. It was no longer legitimate. And so cigarettes were what bought you food. They bought you cameras. They bought you a night with a woman. And so in any society subsequently, what's trusted emerges as money, as though put there by an invisible hand. And so let's think about this in one way in terms of the crypto future. Why do I think there's a crypto future? I do because a capitalist system that can build buildings that go a mile into the sky and that can create supercomputers that sit in our pocket can certainly create a measure that holds its value throughout time. I think the challenge for crypto is that they've turned what is a first-grade problem into an AP calculus problem. Money is not complicated, money is basic. And I think gradually you're going to see a migration back to that. As for the implosion of the crypto market, that's the surest sign of its staying power. That's the surest sign that you know that it's the future. 100 years ago, it was the automobile. Just about every car company failed. 20 years ago, it was the internet companies. They nearly all failed. But both the auto and the internet, they are a fact of life today. Private money is a fact of life simply because in a capitalist society, we demand currency that holds its value, that enables us to trade the most. And in trading the most, what allows us to produce the most at prices that continue to decline. Which brings us to the final subject here. My book, which rejects everything you've ever read about money, also rejects this obnoxious, insulting narrative that there is inflation today. And to think about this, it's important to travel back to the advent of the car. Cars, when the 20th century began, were rarer than millionaires, and millionaires were incredibly rare. And so what changed? Henry Ford saw that if you divide work up among hundreds and thousands of people, you can create exponentially more cars at prices that continue to decline. Fast forward to 2020, billions of workers around the world over decades had created trillions of different commercial, interlocking, cooperative relationships, only for politicians to take away our ability to work and to operate our businesses. That prices are higher today is a statement of the obvious, but I just refuse to tie the imposition of command and control to inflation. Let's define our terms properly. Inflation is a devaluation of the currency. It's a departure from a commodity, from a monetary standard. The higher prices we're experiencing today are the bitter fruits of our freedom being taken. So let's not call this inflation. Furthermore, this would be the first inflation in the history of mankind in which the currency, the dollar, actually rose against just about every other foreign currency and rose against gold. So it should have us questioning what we're being told. Now, naturally, politicians love this, another way to change the subject from what they did. But let's be real about what this is, and let's get to the discussion.
Thank you, John. Thanks, John. That was a terrific summation. And please get your questions ready, especially Mike Kendall. I know we want to hear from him on these topics. So over the previous decade, since the great financial crisis, we had a new monetary regime, quantitative easing, so-called, right, with the Fed balance sheet went from, what, 850 billion to 4 trillion or something, and now it went up to close to 10 trillion, something like that. You're saying, John, that the reason none of that seemed to matter with regard to with measured inflation, and now we're getting measured prices, is because what changed over the last 2 years were the pandemic policies of stopping production. Is that right?
Yeah. To focus, look, the Fed, I defy you to find a writer who's ridiculed the economists at the Fed more than I have. But to tie this to the Fed is an utter non sequitur. I would argue to tie to tie inflation to the Fed is a non sequitur. I mean, you'll find it in my book, but let's just look throughout history. Okay, the first devaluation happens in 1933. Fed Chairman Eugene Meyer begged FDR to not devalue the dollar from 1/20th of a gold ounce to 1/35th, and he was rebuffed. In fact, Fed Chairman Eugene Meyer resigned only to buy the Washington Post. The Washington Post was his vehicle to go after this inflationary president. Fast forward to 1971, Arthur Burns begged President Nixon to not depart the gold standard, which in departing it was the inflation. He was once again ignored. Inflation is a monetary choice. To focus on central banks is exactly what politicians want you to do. But when you think about history, inflation is as old as government's involvement with money. To focus on central banks is to completely miss the point. Governments devalue, they've always devalued. And what's exciting about this, though, is once again, in a world in which we have supercomputers sitting in our pockets, I think a private sector that wants money that it can trust is going to supersede it in the way that Uber basically kicked the ass of taxi cartels around the world. You are soon going to see money circulating that's trusted, that's going to push out government money.
George, do you agree with John that the problem with crypto, at least to this point, or with Bitcoin specifically, is its focus on the supply number rather than the stability of the...
Yeah, I mean, the whole idea of hodl, that you get rich by holding on for dear life some scarce asset is just the opposite of how money really works in capitalism. I mean, under capitalism, you can only keep what you give away. Your money has to be invested. It has to be creatively applied. It has to be entrepreneurially used, or it becomes worthless. As John says, there's no such thing as too much good money. If money is a measuring stick, not a magic wand for central bankers, and that is the crucial thing to understand. And there can be no the more money there is, the more production and initiative and creativity it reflects.
I'll just add, the only limit to so-called money supply or money in circulation is production. Where there's lots of production, there will always be money to circulate it. Where there's very little, there will be no money, and no central bank can overcome that truth. It runs totally counter to what economists have been saying forever. But economists think that war actually causes economies to grow. They think government spending causes growth. What that profession believes is so divorced from reality as to make us laugh at them, as to ridicule them. And thank goodness for people like George who've been ridiculing the pretense of economists for the longest time.
So if we set the Fed aside just for a moment, what about the, say, 10 trillion in extra spending on the fiscal side that we've seen over the last couple of years? How does that fit into your models?
Government spending is the ultimate tax. Government spending is Nancy Pelosi and Mitch McConnell extracting precious resources and allocating them in non-market ways. Unseen with government spending is all the Amazons and Microsofts and Dells that were never created. But it's not inflationary. To pretend that it is like saying that if we want to stimulate the economy, let's just start telling everyone to thieve one another. Take $20 from your neighbor. Well, you'll go out and spend that money, but your neighbor has $20 less. Demand always emerges from supply. That's what's so tragic about what we're seeing at the Wall Street Journal's editorial page. They're saying that this government spending is causing excess demand. There is no such thing as excess demand. It begins with production. And so if people are demanding things because they've had wealth redistributed to them, logically there are people who have less wealth. And so the government spending is a horrifying tax, but it's not inflation. Neither are deficits inflation. But almost by definition, countries that don't devalue can run up much bigger deficits than countries that do devalue. The tax is the spending, but it has nothing to do with prices.
Richard.
Thank you, John. Before my question, just one quick observation. This particular 10 trillion was a little different in that we were explicitly paying people not to produce, right? So in that sense, it unlike, it more than typical government spending on the supply side of the economy. So that's just one way in which I think it's special. John, I like you, I am annoyed no end by the politicians' use of the Fed to excuse their own inactions or actions. And it just occurred to me lately, not that it would improve the situation, but just in terms of assigning responsibility, should the Fed chairman and the other Fed members, should they all be presidential appointments, fireable at will? So at least then the political dodge might be more inhibited.
Oh, well, answer the first question. So let's agree. Let's just assume that it's true that, yeah, they paid people not to work, and there's evidence of that. Well, any reduction in supply is a reduction in demand. It wouldn't have a price impact. Inflation is a devaluation of the currency. Let's get the definitions correct, and I know you know the definition. As far as making Fed appointments, presidential and fireable at will, I mean, why would we elevate what is already absurd? I mean, one of the things that I stress in the book is that this notion that, the Fed caused the 1930s, it limited credit in the United States. Have you ever heard something more ridiculous? I mean, it goes fully counter to Robert Mundell's "the only closed economy is the world economy." The simple truth is that money and credit flow to their highest use, and central banks can't do anything about it. As I point out in the book, China's growth in the 20th century was largely financed by two Jewish men of Iraqi descent who didn't speak a word of Chinese. But they saw productivity in China and they financed it. Fast forward to the 21st century, Bret and George know this much better than I. But it is largely illegal for Americans to own companies in China with websites. Yet what country has largely financed China's technological boom? The United States with U.S. dollars. Oh, they don't allow the dollars in? Guess what? They get there through offshore funding. Just about everything that Jack Ma has created has been a creation of American investment. To then pretend that this Fed can somehow put a stop sign up and not allow growth in the United States insults reason. Now, I get that politicians want you to believe that because politicians want to have an other to blame all the time. Yeah. But we are wise people. And the notion that the Fed could limit economic growth in the United States insults and vandalizes reason, and it's, I would argue, fairly easily discredited in this very short book.
John, why does Wall Street apparently pay so much attention to the Fed? And as an example, over the, say, between the financial crisis and the pandemic, the stock market, basically went up with extraordinarily little volatility. And, everybody you talk to in investment houses and Wall Street and so forth would just say that, the Fed is pumping up the market. What explains that phenomenon?
It's nonsense. I always hear that people say, well, even though you may be right that the Fed's not that important, but investors believe it's important. Okay, well, so they say, yes, the Fed cuts rates and that causes stocks to rally. Well, so from whom are these people who believe in the Fed's power buying from? Are they not investors? This notion that the Fed can stimulate rallies just by fiddling with it begs the question, what happened in Japan? Why aren't stocks to the moon there? Why aren't they to the moon in Europe? But more broadly than that, who's selling to them? It speaks to an information asymmetry that sellers are blindly selling what's obviously going up to buyers who know something that they don't know. But beyond that, let's just ask the basic question. What if the Fed could prop up the existing order as so many assume? And let's think of it in the terms of when the 21st century began. What were the most valuable companies in the world? GE was the most valuable. The best managed was Enron. The next GE was Tyco. The two best internet companies by far were Yahoo and AOL. How are they doing today? If the Fed could prop up stocks as so many assume, the U.S. economy would be so wrecked that we couldn't afford to be here right now. And when we so insult the U.S. economy by presuming, because look at what is at the top today. So when the 21st century began, Apple, Michael Dell had said just a few years before, just liquidate it. It's not worth saving. It nearly went bankrupt. Amazon was Amazon.org. Remember that? Google was a private company that no one had really ever heard of. Microsoft had just been mulcted, just eviscerated, but they nearly broke it up in the federal government. And then Facebook didn't exist because Mark Zuckerberg was in high school. If the Fed could prop up the present, as the Fed narrative presumes, the U.S. economy would be too destroyed for us to talk about. And so let's stop insulting reason and insulting entrepreneurialism by presuming that we rely on people like Ben Bernanke and Janet Yellen and Jerome Powell to lift the economy up. I mean, please, we're smarter than that.
John, at the risk of agreeing with you excessively, one thing that we saw over the past decade plus since the financial crisis, as the Fed, as the sort of big banks became quasi-government utilities, right? And interest on excess reserve regime and the regulations which depressed their previous sort of lending functions, we saw this huge explosion in the private credit industry, right? Which we saw at our state pension fund in Indiana. We have, huge investments in the private credit world, which rose up, right, to take the place of the banks, which weren't lending anymore. And so that's just an example of, I think, what you're talking about. Is that?
Well, yeah, I mean, the surest sign that the Fed's not that important is to look at the banks that it projects its well overstated influence through. Banks, by their very name, by virtue of the fact that they pay very little on interest, cannot take risks. They have to lend to those who basically don't need it, who could go to all sorts of other sources for credit. Contrast that with the genius in this room, with Silicon Valley, which you guys track all the time. Just about everything ever created in Silicon Valley fails. That's the source of its dynamism. Think banks can touch that? So the most prosperous, most dynamic part of the U.S. economy, the Fed has absolutely zero impact on, simply because there's no interest rate that you could hike the rate to that would have anything to do with what happens in Silicon Valley. Everything dies there. What if the business model doesn't work in Silicon Valley unless the finance is equity finance, which means we're focused on the Fed, and why?
George, one question. Oh, you want to go here?
Yeah. Might as well.
Yeah, sure.
Thanks, George. We have hundreds of problems with maybe dozens of solutions, so this is not a binary. There's not one easy thing to come to an answer. One of the wonderful things about democracy is you cannot vote on a fact. And one of the facts is that we do have superabundance, as Marion has put out, which has come from the investment of entrepreneurs, people taking risks, people who did not hoard. But there's one factor that is hit so hardly by government force and taxation, is that you can invest or not invest, but the person who is paid by the hour, the working class, cannot hoard time. We are eviscerating the middle class because we can do nothing about it, because we are paid on a time basis. And I wonder about the time price of debt. So, in my opinion, the use in multiple levels in areas around the world is a force, government force, whether it's the Fed or what is coming up with central bank digital currencies. Can you comment on, do you think Fed coin or other central bank currencies will increase this application of force to counter investment and generation of wealth?
No, and I think you know why, because the governments don't know what money is in the first place. If they knew what money was, they wouldn't be devaluing it all the time. This is going to emerge from people who have a clue about what money is. Economists, as I point out in the book, and all of you know this, believe that devaluation is the path to prosperity. That is how divorced from reality this most superfluous of professions is. And so the idea that an entity that has been devaluing money for as long as it's been involved with money is going to somehow get digital currencies right is truly the definition of the triumph of hope over experience.
Well, central bank digital currencies will necessarily be valued in some global digital currency that actually reflects the truth of a monetary measuring stick. I mean, what Hayek said, Friedrich Hayek, the root and source of all monetary evil is government control of money. If this root and source of monetary evil gets transmuted into some central bank digital currency, that currency will have to be valued. Gold has been the chief way currencies get valued over the years, but I expect to emerge a global currency and set of currencies based on blockchains that have a secure value and into which all the central bank digital currencies will have to be valued. That's how we'll be able to tell the value of these central bank digital currencies. But they themselves don't have any special virtue that counteracts Hayek.
One quick question then, that's now, I use a thing called the BEL, back-end liquidity liability, where I take my accumulation of surplus, whether you call it money or whatever, and how convertible is it when I stop being productive to convert back into the essentials of life, shelter, energy, food, and water. I look at everything now in the back-end liquidity as to whether what we use for storage now will be convertible in the future.
Just before we get to John Woolstetter, is gold still a useful anchor, guidepost?
It's very useful, and I learned this most from George. George has continuously risen the amount of currency trading that happens per day.
Yeah.
To be clear about this, before 1971, there were no currency markets. They largely didn't exist, and why didn't they? Because money had strict definition. Money was a measure. the fact that what verifies gold's global use and why it's so necessary, or something stable is so necessary, is the fact that there's trillions of currency trading every day. That is the market signal that those moving goods around the world don't trust the measures enough to not actually hedge against them.
John.
Yeah. In a world of blockchain and digital currencies and multiple currencies, how do we measure the value? For example, I've always thought that the Fisher equivalency, money times velocity equals price times transactions, is a good way to do it. I realize he wasn't a good stock market forecaster, but is that kind of a measure going to be useful? Are we going to just have so many different valuations that we're so balkanized we really don't know?
The assumption, Friedman's assumption, was that velocity was an externality, that velocity was determined by cultural values, that people, and so because velocity was a constant, then the supply governed economic activity. And it turns out velocity is nothing like a constant. It changes radically from day to day, and at the end of his life, Friedman acknowledged that velocity changes, and thus his money, in the future, he would not emphasize money supply as much as he did. Velocity is the way we control money. But my theme is my new book, and Life After Google, and all developed this issue that in an age of superabundance, when everything's abundant, the measure, what remains scarce is time. And money is the way time is fungibly transmitted across an economy, and money really is time. My trinity is wealth is knowledge, growth is learning, money is time, and that is and any sort of speculative use of money is really falsifies it, because and I think this is why I'm so enthusiastic about time prices, which Gail Pooley and Marion Tupy have developed so beautifully in superabundance.
Next.
So the comment about the central banks and Wall Street, and why does Wall Street listen to the central bank so much? It's probably because they are the greatest supplier. They are the central of the supply. And the further comment about velocity, as interest rates tend to rise, we do tend to see a little bit more velocity, right? And back to that not being constant. And one thing that you just said was the most stable measure of commerce is money. And the Bitcoin, as a result, it has a stable measure of 6 coins every 10 minutes. Is that not stability? And
No,
increasingly
it focuses on
unstable.
supply. I don't know what supply should be. And the point is, the supply of money is only limited by production.
So
and
I just ask to finish asking the question. Shouldn't the in our increasingly unstable interest rate environment, in our increasingly unstable central bank environment, and dollar swaps and all the dollar strength, dollar weakness, so on and so forth, increasingly instability financial system, this is a flock to stability because there's at least some math oriented around it.
But to me, at least, Bitcoin right now amplifies, is just all the turbulence that we see in the dollar market, but it's just exponentially more. And I just think, does anyone think that Fred Smith, the founder of FedEx, thinks about money velocity? I mean, to me, velocity is just a consequence of production. Where there's a lot of production, there's going to be a lot of velocity, but markets will happen upon the most trusted currency to move the production around. I'm not against Bitcoin. I think Bitcoin is instrumental. Without it, you needed the interest in it to derive interest more broadly. I just think Bitcoin is going to be the netscape of the revolution, necessary but not the leader of it. Money, if you look throughout history, and it came from a book that George recommended me by Nick Batia. Batia got the history right without understanding money properly, but if you look throughout history, what's most stable invariably emerges, which is logical, because no one buys or sells or lends or borrows. Underlying financial transactions is the movement of real goods and services, and precisely because we don't want to get ripped off, we migrate to the money that is most trusted, so that when we take money in return for our work or our goods, we can then buy equal amounts of goods and services in the economy. There's nothing complicated about this. Bitcoin is really a remarkable thing, but its focus on supply completely misses the point.
Good morning. Thank you, John and George, for your comments. I'm Scott Kuznicki, a fellow with the Discovery Institute, and I'm running our automated connected electric and shared Northwest network. And I can't help but find parallels to the transportation system in Seattle, where a centralized group is claiming that they have the solution to capacity, to supply in transportation. If only we would allow them to plan for the choices of millions of individual consumers, then we would have utopia, where you could catch a bus within 30 minutes and arrive at least 1 hour late. So, and as a student of Milton Friedman, Thomas Friedman, I would say that, John, I tend to agree with you that the market signals are important, and now in the information economy, where, as you mentioned, all of this information is available to me. So how do we overcome the hype of the centralization forces that would say we are going to influence this, we are going to create the supply, we are going to manipulate the supply, and put the information back in the hands of the consumers so that people understand not so much what is the supply of money, but what opportunities exist for me to invest? How do we continue to go down that road in our culture and in our society vis-a-vis money?
Well, you know, Travis Kalanick put an app on our phones that allowed us to overcome the planning of taxi supply. And it just strikes me that a capitalist system that can do that can also issue monetary units that are trusted. And with that, my strong sense is how they start circulating broadly. It's not going to be from my parents who are 80 and 78. They will stick to the dollar, but think back to when the 21st century began. As we learned from PayPal, most monetary transactions when the 21st century began still occurred through the U.S. mail. Who brought us out of this antiquated way? Young people. My guess is that young people will once again teach us how to use private money. And as more and more of us go into a store and say, do you take Amazon dollars or JP Morgan dollars? And they say, yes, we do. And they say, yes, we do, because they're thinking we trust them to command equal goods and services. Gradually, you'll see this circulation grow and grow. And with that, you'll see better monetary outcomes overall.
And then the follow-up question is, do you believe that energy will play a role in shaping or perhaps becoming the currency of the future?
No.
No, right?
Last question.
It's time.
So I hear this debate all the time, right? And I've always wondered, like, it's not really fair to compare cryptocurrency or evaluate it anyway, because it's always being manipulated by Wall Street, stock market. And as long as there's no shielding around it, you're always going to have shorts, longs, people who are manipulating the market. It's never been fully decoupled from the normal dollar. I mean, I'm assuming that's correct. So that's why we never really get a fair shake on cryptocurrency.
I don't think that to be a short in a market is to be a buyer, by definition. If you're short shares, you're a buyer of shares. In any transaction, there's always two sides to it. And so this manipulation thing that I always hear about, oh, please, come on, for the longest time, currencies have been stable. Currency price stability is a choice. Eventually we'll get to it, and we'll get to it because that's what the markets want. Again, as George points out, this trillions of currency trading is the market's way of saying we want what is stable. And eventually, just as every advance in society, what is it born of? It's born of someone's got a margin there that we're going to erode. And so they're going to erode the profits born of trading currencies, which is just a waste of exponential amounts, enormous amounts of genius. And so with that, people will say, okay, we can get around you. And with that, there will just be less currency trading.
So then maybe you can humor me for just a minute and go on this thought experiment with me. So in the future, we go off planet. And assuming humans never break the universal speed limit of c, we travel very far to another planet, to the point where transactions cannot reach Earth in any reasonable amount of time. So now you have a complete society of people who arrive at a planet that is completely decoupled from Earth. And they observe and they mine a rare material they've never seen before. Let's call it super unobtainium. They didn't bring any US dollars or any kind of currency with them to this planet. It would take years for any kind of credit or debit memos to reach Earth. They have no currency, so they spin up, because it's very easy to spin up a cryptocurrency blockchain, completely based on super unobtainium. Wouldn't that be a proper use case to correctly judge cryptocurrency that's completely backed by a material that people can now use, barter, and trade without the manipulation of Wall Street or any kind of shorts, longs, bulls, and bears?
Okay, go ahead, guys. We'll close with that. Go ahead.
I'll leave it to you. I don't know, but I just know that if you look throughout history, wherever there's been production, money, something that's trusted has always emerged to facilitate the exchange of it. And so I don't see what would be different about another planet.
Great. Thank you, John and George. Terrific. Appreciate it.
Let's give them a round of applause.